one of the most confronting questions for us as an industry is the question most asked of my chief executive in media interviews. Is the coal industry dead? It's a frustrating question, and I'm sure all too familiar for you in the coal value chain. However, earlier this month, the World Coal Association had the privilege of joining participants from Russia and key emerging markets at the St. Petersburg International Economic Forum. If these delegates were polled on whether the coal industry was dead, the answer would have been an emphatic no. Emerging economies are looking to develop their industries, energy security, securing future reduction of coal assets to create direct and indirect jobs, manage energy affordability, fund future coal and clean coal projects, and share technology and develop innovation. This reality for coal is completely different to the popular narrative, which doesn't differentiate between coal as a concept, its various uses, or the fact that its emissions problem can be addressed. For many, especially in the global north, coal is synonymous with the problem of climate change. A contributor only to a problem, and it's never identified as a positive. People choose to list coal on the cost side of the ledger without an offsetting contribution on the benefit side of the equation. We hear about the costs of the coal industry all the time. But what about the benefits of the coal industry? And where does the coal industry fit?
So here I would like to show the factual dynamics of steel production in China and in the rest of the world, of course. So despite many forecasts that steel production in China will start declining, actually it is growing steadily, showing impressive surplus every year. So, and what is more important is that this production growth mainly came from blast furnace sector. In the chart below, you can see the dynamic of pig iron production related to crude steel production. Despite the reduction in steel production in the rest of the world in 2020, China's share in global steel production rose to 56.5%. In the first quarter of 2021, with global growth of 10%, China grew by 15.6%. And we expect that this year China will further increase its production of steel. Of course, there are some factors that can limit this growth. Well, first of all, this is a political regulation of steel sector in China. Ministry of Industry and Information Technology of China has called for a reduction in steel production in 2021 as part of a plan to achieve carbon neutrality by 2060, with a peak level expected in 2030. And many steel mills in Tangshan were obliged to cut their production in 2021. In addition, in May, China removed tax rebate for steel exports. But well, here I think it is worth noting the state of the market when which goal was set. So steel production cut that was in 2020 has opposite effect in 2021. Robust demand to a limited supply led to a surge in global steel prices. And on the one hand, high steel prices can cover high cost of raw material basket, given the very high prices for iron ore and coking coal in the Chinese market. On the other hand, Chinese steel mills that are located in other regions, so these high prices, they prompted them to increase their utilization rates and expand exports.
And just a little bit of a drill down on China. This year is shaping up to be a pretty decent year as far as growth is concerned. If you look back historically on the supply side, we haven't really been able to break above 3.2 million tons in terms of clean thermal coal supply. The last time we saw that figure was back in 2014. But it does look like things are thawing to a certain extent. And when we do get past the mine inspections and the 100th anniversary of the Communist Party, we would think that certain things will get, we think certain bottlenecks to a certain extent may get alleviated. Obviously, the 100th anniversary is certainly impacting things as well. The accidents notwithstanding. Consolidation is certainly allowing larger players to expand production bases. New mines are also being approved. But again, we don't think the situation will be, we think they will kind of compensate for lower imports with power rationing and things like that versus, let's say relenting on the Australian ban, for example. Next slide. Thermal coal demand in the U.S. will, I'll speak to the U.S. because obviously it's a much bigger market. Thermal coal demand in the U.S. will be up this year, namely again, from a demand standpoint, we're already observing, higher loadings from PRB, and, across nearly every basin, whether it be the PRB, the IOB, CAP, and NAP. Met coal demand in the U.S. certainly is kind of in somewhat of a structural decline to a certain extent, given the fact that you have more EAF starting up in the U.S. But yeah, thermal coal, unfortunately, probably continues to just, drift down the curve, so to speak, because you do have announced retirements throughout over the next 10 years. That'll continue to chip away at primarily PRB volumes. We actually did some recent analysis on the mines that both Peabody and Arch own. Peabody's probably a little bit more exposed to the PRB side, but the Illinois Basin retirements are pretty scant. They're obviously benefiting from the fact that they have relatively better, they can compete better with regional gas prices, whereas the PRB is oddly enough shipped across the entire country and into power plants in the mid and southeast. So when you talk about competing with regional gas prices, I think it's pretty easy comparison. And then when you talk about stacking up where some of the new renewables capacity is also being put into place, it's competing right in line with PRB coal. So, thermal coal demand, after the bump we see this year, will probably continue a structural decline in the US.